This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Are going to get straight to the chart deck here. Listeners, you're going to find a download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Larry's picture saying looking for the downloads. Now, I want to just start off with the crude oil chart here, Nick, and it's been a really good run. I've more or less been bullishly siding with the trend because the price action has been accumulative. It's been staying above its 50-day moving average and working higher. The key is that we actually now have beat Fibonacci retracement zones from the 2023 market correction. And so at this stage, I'm really curious whether the bulls will be able to get this back up to the highs that we both saw in November of 2022 and in September 2023, especially in light of escalating geopolitical tensions. Maybe a little bit of oil premium might be coming in here.
Well, that's just it, right? I mean, you look at the Fed and their decision-making right now, and a lot of it is predicated upon inflation. If we get energy prices skyrocketing again, that's going to make it very hard for them to cut rates, and it's going to actually guide markets probably lower in the shorter term, which leads us to the discussion on the S&P.
All right. Well, let's jump straight to it. Let's first start off with you giving the levels. What are the levels on the S&P?
So right now we have a spot price of approximately 52.10 on SPX. We have an implied move for the April 19th monthly OPEX of plus minus 110 points, which gives us an upper implied move of 53.20 and a lower implied move of 5100. So right now, what I'm seeing is that we're seeing a lot of consolidation in this area, perhaps a pause overall, but the last 3 days or so have kind of given me a little bit of jitters, or so to speak, in terms of staying long in the market. And I mean long in terms of the short-term positioning, not my long-term positions. Because oftentimes before a larger correction, we see these kind of downward cycle moves. And with the Fed members yesterday discussing possibly only one cut this year, going from, 4 initially to now 1 cut, that's a big change in the overall theme that a lot of market participants were expecting.
Yeah. So on page 4, I have that S&P 500 chart. Normally, I show the yellow 50-day moving average, but in this case, I put the 20-day moving average on here because it really has contained almost every short-term correction the S&P has had. More importantly, going back to the start of the year, there's been this upwards channel in the S&P 500 drawn between those red lines that has defined that escalator ride higher that these markets have been systematically doing. What's really interesting is now these trend lines and moving averages are just sitting north of 5,200, which is not far from where the low from yesterday came in. And so what will be interesting to see is whether or not the bulls do what they have successfully been doing all year, which is they buy this dip and they work it to the top of the channel. The way, it's interesting that, Nick, that we're going into the jobs numbers tomorrow, and the jobs have not played a big role in creating market volatility in the last half year. But it's interesting that we're at this key pivot moment right along a very key support line at the moment when a relatively important news release or economic release is coming out. Be interesting to see whether Friday brings about some volatility that breaks any of those downside support lines. Right now, though, the bulls are in control. And while certainly that first day of selling has created a little bit of nervousness, by no means are the bulls in trouble yet. But at some point when this trend line breaks, a proper 300 to 500 S&P point mean reversion will get started. It's really just now the solving the puzzle piece as to whether this is the point where that turn is happening.
That makes a lot of sense to me, actually, because when you look back to last year, when we finished the year up 23%, we had 2 instances of the market correcting by about 10%. So we're already in April right now. If we predict that we're going to finish the year up around 15-20% this year, despite this nice bull run, we should expect some pullbacks at some point, right? Like we're not going to shoot straight up nonstop. So what you mentioned about that 300 to 500 point correction makes a lot of sense because that's about 10% or so to the downside. So again, I'm always very cautious about this because it's when you have those pullbacks where the greatest opportunity resides, right? You get those insane opportunities where, certain names that should not be beaten down get beaten down because of broad market pullbacks. That's where you get those awesome opportunities to go long.
All right, well, let's move on to the Nasdaq because I actually have some comments here, but let's start off with just the levels.
So right now in the Qs, we have a spot price of approximately 443. We have an implied move for the April 19th monthly OPEX of plus minus 11 points. That gives us an upper implied move of 454 and a lower implied move of 433. As I mentioned in previous weeks, I'm bullish on certain names, namely Google, Apple right now. Google's done very, very well the past few weeks since I caught that bottom around 132 or so. It's up at around 155. Apple is still sitting around support area at 169 or so. But short term, I see those two names being strong. Meanwhile, we're seeing names like Tesla roll over. They had poor sales numbers earlier this week, and it's possible we see Tesla roll over to 150 or so area. I do like Tesla in the long term for reasons I won't get into, but in the short term, I think it could pull back down to 150 or so.
Well, when we look on page 6, and I have the Nasdaq futures chart on there, the interesting thing that we're seeing is that there clearly is evidence of a sector rotation. And while certainly Google had a nice, good run on the upside in the last little bit, it's also countered by the fact that NVIDIA has more or less been correcting for now 6-7 days. And the buy on dip traders that normally would come in at these levels have at least not at this moment showed up. But the interesting part here when we look at this chart is that really the Nasdaq has not participated on the upside at all in the last month. It really has been an S&P 500 rally, and the Nasdaq has been flat. And you can really see that, Nick, when we go to page 7 and look at the breadth of the market. And what I have is the breadth of the market. On the left, we have the Nasdaq, and on the right, the S&P. And what you can see is that we have a breadth based upon the percentage of stocks above their 50-day moving average on the Nasdaq of 42%. Even during this entire month of March, when there's been this big rally, it barely could get above 50% of stocks on the Nasdaq above their averages, which basically is showing that there's a pretty distinct distribution in that Nasdaq basket. At the same time, that S&P 500 got up to 85%, and that really was a broadening of the market, particularly a few sectors like energy. And that's where on page 8, I am showing the sector performance for the 1 month. And you can see the energy sector up 11%, communications up 8%, basic materials up 6%, even utilities up 4%. And yet those areas like consumer defensive, consumer cyclical, and technology, including real estate, have actually all been distributing. And so that sector rotation has really been the name of the game here. And the question here is that can the market have another significant move higher when the distribution in the Nasdaq continues?
Yeah, Patrick. So looking at the communication services in particular, that sector to me is more of a tech basket. Because if you look at the holdings in that, you see that Meta and Google are the top 2 holdings in a lot of communication services ETFs. So right now, that to me is more of a tech performance. So we're seeing energy and tech outperform handily, basic materials obviously as well. And then we're seeing tech not really so broad, as you mentioned, because a lot of this is selective choosing of names like, Apple, Google, Amazon, Meta, as well as NVIDIA.
All right, Nick, let's get on to that volatility index. We've finally seen a little bit of a spike, but nothing to write home about. We are at the 14 handle, still within the range that we have seen all year. We bounced around from, the mid 12 range on the VIX, always got up to towards 15 and then right back down. What are the current levels on the VIX telling you?
So right now with the VIX sitting at approximately 13, that tells us that we should see intraday top to bottom moves of about 0.75% roughly. And we're seeing these implied ranges stick for the most part each and every day. So what I'm tracking is, for example, around noonish each day, if I notice that the implied range exceeds the current range of top to bottom for a given day, that tells me that we should see some activity into close, which has happened the last few days. We've had these violent runs up or down, mostly to the downside, where we dropped 20 points in the last hour, for example, which happened yesterday. So tracking the VIX right now is not really so useful for short-term movements. In the longer term, what I'm seeing is that insurance is still very cheap. And if you want to hedge your portfolios, it makes a lot of sense to purchase insurance longer term, perhaps using spreads, because spreads are going to be your friend, and they're going to offer, incredible asymmetry of risk, where you can, for example, risk $1 to make 9.
So, Nick, I want to move on and talk about commodities, but I really wanted to step back and look at them on weekly charts in the real big picture, and just to see what kind of major trends could potentially be getting underway. And I thought the best way to start is to look at that Bloomberg Commodity Index on a weekly chart basis. And you can see that epic bull run in 2021 and into the start of 2022. But we've now been in about a 2-year correction in the commodity basket. It's been consolidating off of its highs, but in the last couple of weeks, we have seen that commodity index actually attempting to break out. And we obviously have not beat the third and fourth quarter highs of last year, but it's certainly an uptick that is worth watching. There's still a lot of commodities that are not participating, such as grains and other types of soft commodities. But at the same time, the fact that energy has turned up is a real big plus for this. And it'll be interesting to see whether that actually creates any further follow through. So on page 11, I have the gold chart. And this is again the weekly chart, and all of those major highs in 2020 and 2022 and 2023 that all happened around the 2000 level, we've now definitively and decisively broken out of that range in a very bullish manner. Now, a lot of technicians are very quick to point out some of the measured moves of the 2700 as reasonable targets, but right now this 2300 was actually a very key target, and this is actually a natural place for gold to pause and consolidate the breakout. Now, to me, that's not bearish. In fact, if gold here pulled back $100+ towards 2,200, but decisively stayed above the 2,000 level, it would just offer a compelling buy on dip for a continuation pattern. But right now, on the very short term, I'm not as optimistic that this just goes in a straight line to 2,700, but it remains very bullish.
Yeah, I agree with you on that. Like, I've been holding gold for the past 10 years or so, physical especially, and watching this long base form, the saying, the longer the base, the harder the move up. So right now, what I'm looking for is a break toward 2,500 or so. And I do see a very, very strong move toward 5,000 an ounce in the next few years after this long base.
It's interesting in terms of that kind of a target. Like when we look at silver on page 12, this is actually a really interesting chart to me, because I wanted to capture more than a decade, because I wanted to go back and look at that silver bubble that happened in 2010 to 2011. It was just a melt up in silver where it went from the teens all the way towards $50 an ounce. And since then, there was this prolonged period of consolidation. Now, back the 2020s has seen a bullish breakout and consolidation for 3 years of silver sideways. And we're now approaching, once again, the highs of that last 3-4 years. It would be incredibly technically significant if silver was able to break out of this area to confirm that the precious metals markets are running. I don't have a chart on it for platinum and palladium, but they've really not participated at all yet. But silver might be the first precious metal outside of gold to really confirm a new bull breakout.
Yeah, with silver, you have a lot of industrial applications for it. So, for example, right now, approximately 56% of its supply is used in industry, whereas for gold, it's about 12% or so. So it makes sense that if we're using silver for actual applications, it would have a nice run as well, right? I think a target of around 30 or so in the short term would make a lot of sense. But moving on to page 13, we have this copper chart. Patrick, what are you thinking over here?
Nick, copper's been in a consolidation for 2 years, no different than that commodity index we talked about earlier. And similar to the chart trying to break out there, we're now approaching the 2023 highs, and a lot of people are getting excited about the short-term upside of copper. I think that as we approach this 430, we're going to get a really important tell. Typically, when we test an area like this is where the market pauses and mean reverts and corrects. Long as old dips are being bought and the price action stays accumulative, it'll be interesting to see whether the bulls can put together a further run up toward $4.75 or even $5 going into the year end. I overall remain quite bullish commodities in general. I just am trying to decipher whether or not it should be as immediately bullish here in the second quarter of the year, or really whether it's something that is a fourth quarter of the year going into next year kind of story. Right now, we're going to get a lot of information about whether or not these follow through when looking at that. Finally, Nick, I wanted to just touch on these uranium charts. And with this uranium, we haven't seen it clear any major hurdles. Like for me, with the Sprott Physical Uranium Trust, I was looking for it to get above 30. For the U308, I wanted to see it clearing that 90 to 93 level area. We just haven't seen the physical uranium get any traction on the upside yet. But what I'm curious about is whether or not the uranium stocks are signaling something, because on page 15, I have the Global X Uranium ETF. In the last week, we have seen a legitimate bullish breakout of uranium miners, and they have now shot right back up towards year highs. And curious whether or not the investors are sniffing out that another up leg in uranium may be starting that hasn't yet reflected in spot prices. We saw that similar thing happen in copper, where the copper miners have been running for a month before the copper commodity actually broke out. So it's certainly something to watch.
Folks, if you enjoyed Patrick's chart deck, you can find them every single day of the week with a free trial of Big Picture Trading. Just go to the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.